Money is an essential part of life, yet the way we understand and manage it is often shaped by the insights we receive from our parents, friends, financial experts, advisors, and economists. While their knowledge is invaluable, there are aspects of money and wealth building that remain largely undisclosed or understated. We will explore the lesser-known truths about money that financial experts may not openly share. I remember when I graduated from my undergraduate studies, I took a job as a financial advisor at one of the large companies in the United States. I gained some valuable insights on how the system operates. Financial advisors are often portrayed as trusted professionals, helping clients secure their financial future. However, what many people don't realize is that most advisors work on commission-based models. This means their recommendations may be influenced by incentives from financial institutions rather than what's best for you. Some advisors push certain investment products or insurance policies that earn them higher commissions, even if those choices are not the most beneficial for you. Even when two options seem equally viable, an advisor might steer you toward the one that benefits them more. For example, an advisor might recommend a mutual fund with higher fees because they receive a bigger commission, even though an index fund with lower fees would be a better choice for you. Life insurance policies, annuities, and actively managed funds are often heavily promoted because of the substantial commissions involved. Always question financial recommendations and consider working with fee-only financial advisors who do not earn commissions from third-party financial institutions. Most financial experts warn against debt, urging people to pay off credit cards and loans as quickly as possible. While avoiding high-interest debt is crucial, strategically leveraging debt can be a powerful wealth-building tool. Real estate investors use mortgages to finance properties that appreciate in value, generating passive income. Business owners take out loans to expand their operations, increasing long-term revenue. Stock investors borrow money to trade on margin when they see high potential returns. The key is not to fear debt, but to understand how to use it wisely for financial leverage. Let us know in the comments if you want us to make a video on how to use leverage to grow your financial income. Many financial experts imply that stock market investing is best left to professionals or the wealthy. If you have watched our video on breaking free from bad money habits, you will see that we encourage you to invest in the stock market. In reality, anyone can invest with as little as a few dollars through fractional shares or exchange-traded funds. With low-cost index funds, even beginners can build substantial wealth over time without the need for constant trading. The main ingredients to success are time and consistent investing. Long-term investing with a simple strategy often outperforms complex trading techniques pushed by financial gurus. Financial experts often discuss inflation in terms of rising costs, but they rarely mention that inflation disproportionately benefits the wealthy. This is because the wealthy own assets, while most people just earn wages. Assets such as real estate, stocks, and commodities tend to increase in value over time, outpacing inflation. Meanwhile, wages often struggle to keep up, making it harder for middle-class and lower-income individuals to build wealth. To mitigate this, focus on acquiring assets that appreciate in value, such as real estate or index funds, rather than keeping cash in a bank account that loses purchasing power. One of the biggest financial myths is that you need a massive salary to become wealthy. I have many stories where I would recommend wealth accumulation strategies to people I know, and most of them would dismiss it, saying that it is for the rich people. It is hard to assist those who do not envision themselves in wealth. Which is another reason that we started this channel, to share the information with people looking for this information to help them along their financial journey, by removing most of the research and mistakes that we made along the way. Financial independence is built through smart financial decisions rather than high income alone. Someone earning $60,000 per year but saving and investing wisely can accumulate more wealth over time than someone earning more than $200,000 annually but spending recklessly. Living below your means, investing regularly, and minimizing unnecessary expenses often matter more than salary figures. The key isn't just earning more. It is learning how to keep and grow what you earn. Some financial experts promote real estate as the ultimate wealth-building tool, but it's not always a perfect investment. Owning property comes with costs such as taxes, maintenance, and market fluctuations that aren't always predictable. While real estate can be a powerful wealth-building asset, it depends on location, timing, and financial strategy. Sometimes investing in stocks or businesses provides higher returns with fewer obligations. Before investing, analyze whether real estate aligns with your financial goals, instead of simply following advice that real estate is always the best investment. Real estate, like any other wealth strategy, requires time to study and maybe more involvement to succeed. There are many stories of rags to riches through this method, and if you decide to go down this path, I suggest that you read up on free resources and podcasts to get a better idea of what you want to get into. We know of a few people who joined real estate boot camps that promised success and charged over $30,000 for a week-long seminar just to leave the students with large credit card debts and shattered dreams. Retirement accounts have hidden fees that can drain your wealth. Many financial experts encourage saving for retirement in 401ks or individual retirement accounts, IRAs. While these accounts are excellent for long-term savings, they often come with hidden fees that reduce your wealth. Expense ratios, administrative fees, and management costs can slowly erode investment gains. There are other fees that you may not have heard about, such as 12b-1 fees and load fees. These hidden fees will hurt your bottom line and prevent you from accumulating wealth at an accelerated rate. Therefore, before committing to a retirement plan, review the fee structures of different funds and opt for low-cost index funds whenever possible. The U.S. government encourages consumerism for economic growth. Thus, we find it ironic that most financial experts focus on budgeting and investing, but rarely discuss how governments push consumerism. The economy thrives when people spend more money on marketing, credit availability, and policies are designed to encourage excessive spending rather than financial independence. Easy access to credit policies encourage borrowing to help stimulate economic growth, but they also keep consumers in debt. Understanding this allows you to avoid unnecessary purchases and focus on wealth building rather than excessive consumption. Understanding hidden incentives allows you to make more informed financial decisions. Financial experts, banks, investment firms, and even governments shape money advice based on their own interests, which mean you need to look out for your own interests. By recognizing these motives, you can take control of your financial future rather than being steered toward decisions that primarily benefit others. Check out our other videos to learn more about how to become financially free.